This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We're hosted by me, Benjamin Felix, and Cameron Passmore.
Episode 96.
Yeah. So right off the top, we had some feedback from somebody, and this is I don't know if this is true, if it's my favorite kind of feedback, but it's one of my favorite kinds of feedback, where somebody discovers our podcast, goes and listens from the very beginning, and takes notes the whole time, and then sends us the notes or the feedback or whatever.
And that happens more often than you would guess.
It's happened maybe not that often, but yeah, it happens more often than probably you would guess. But it's cool because I know that person, assuming that they're telling the truth, which why would they not be? They've gone and listened to the whole progression of the podcast and how it's evolved. We've changed the format over time, and we've changed, hopefully maybe improved over time, who knows? But anyway, and then they can come with feedback knowing that whole history. And I think that's very different.
Be mindful of this feedback, though.
Yeah. So... But I think this still counts as a personal update. I don't know. So the feedback was that the intros, while easy to skip, are too long. And I appreciate that because sometimes I can feel that we are just rehashing what we just talked about in more detail in the episode, which doesn't make any sense. So our new resolution is to have shorter introductions where we keep it only focused on personal updates and don't go over necessarily what we talked about in the episode. Maybe reference it briefly. I don't know. But not like a detailed overview of every topic.
Agreed.
I think it's okay to have... It is really good feedback. I think it's okay if we highlight favorite parts about what a guest talked about. I don't think that's problematic because that's kind of new content. But anyway, we won't rehash what we talked about in the episode. All right.
So since we finished Ozark, we looked for a new series to watch. So we were recommended to watch Ray Donovan. Pretty good. Not quite as good as Ozark, but we're going to give it a chance, especially since we paid for the whole season off of iTunes. But listen, have you watched, I have not yet, but have you watched The Last Dance yet, being a basketball guy?
No, everyone keeps asking me that. I don't watch a whole lot of TV.
Well,
I spent all weekend reading about quantitative easing and whether it's inflationary or not. My eyes were almost bleeding. I didn't watch it. I don't know. And it's multi-parts too, right? I don't like multi-part stuff. If I'm going to watch something, I like to go sit down, watch a movie, maybe before I go to bed. I don't like it into shows. And it's this whole thing, and you gotta watch it every day because you want to. I don't like it.
Anyways, today's episode is a little bit different. We kind of chucked our format for this week, so it's part us, part guest. The guest is someone who was recommended to us on Twitter because we wanted to talk about, given this crisis, someone who has, macroeconomic / real estate background. So we had Ben Rabidoux join us, and he was great.
Yeah, he was great. He's been on several other podcasts. He was on the Canadian Couch Potato podcast. I think that's how I first heard about him. But yeah, expertise in Canadian macro, largely focused on housing and credit. But he's got data to back up everything he says, which we appreciate. One thing that Cameron and I were both conscious of after we kind of debriefed the conversation that we had with him is that we often try to keep things actionable. Like, how can you take this information and go and make yourself a better investor or a better person? And I think, while this episode was fascinating and heavy on cool statistics and economic information, maybe a little bit lighter than usual on actionable stuff. So we hope that's okay. But I think it was still fantastic information.
Agree. So with that, we'll let you listen to episode 96.
Welcome to episode 96.
So have you noticed the increase in concentration of value of the 5 biggest stocks of the S&P 500?
Like the value-weighted concentration?
Yeah, like the Microsoft, Apple, Amazon, Alphabet, so Google, and Facebook are now worth the same as the bottom 350 stocks in the S&P 500.
Wow.
Now, the summer of 2018, so less than 2 years ago, they were worth as much as the bottom 282. Now they're worth as much as the bottom 350. It's just incredible.
They've been resilient, even with all the stuff. Well, relatively resilient. Still dropped.
Yes. And the S&P 500 trades at 17% below its all-time high, right? However, below the surface, and when you take those top stocks out, the median S&P 500 trades at 28% below its record high.
Oh, wow.
So that's how much those big stocks are, not just those 5, but the big stocks are carrying a lot of the weight.
Interesting.
So many interesting data points that perhaps we can have more time in a future episode.
Yeah, that does speak to my comment about the resilience of those bigger companies. Makes you question the value premium a little bit, doesn't it?
Well, I know we're going to talk about that in a couple of weeks, but boy, we're getting at levels that haven't been seen certainly since, I think, 1999, some of those charts that we were sharing this week.
I got some really interesting data of U.S., and I don't think I have permission to share it yet. Maybe I can get that permission, which would be nice. But it's the price book for U.S. Well, actually, I got U.S., international, and emerging markets going back for US to 1926, for international developed and emerging markets, not quite as far, but still as far back as the data go. The price, the spread, the difference in valuation between value and growth is as big as it's ever been. So the value spread is what some people call it, is as wide as it's ever, almost as wide, not quite as wide as in the US as tech bubble time, but it's a hair away. It's pretty much there. It's probably there by now.
Right.
Because that chart's from, I think, ending March. Yeah.
Anyways, so up next, we have a listener question. So let's play the question and we'll come back on the other side.
Hey, Cameron and Ben. My name is Riley and I work at a tech company in Seattle, Washington. A significant portion of my income comes from company stock awards, which vest over time. And so I was wondering, how can I factor this into my financial planning, given that I can't diversify away the risk of holding so much in a single company until the stock actually vests? Is there some sort of framework that I can use? Thanks. Love the podcast.
All right. So Riley in Seattle, thanks very much for that. So Ben, what are your thoughts?
I mean, this is something that we see a lot when people have a substantial portion of their income in unvested equity with their employer. And it's tricky from a financial planning perspective. Like, we deal with this every day. How do you treat it and how do you think about it? I don't know if there's a right answer. There are different ways that we treat it in practice. Sometimes we treat it as an asset. So we take the after-tax Canadian dollar amount and maybe gross it down a bit because obviously volatility in individual securities, and then include that as an asset in the plan.
To me, that's the key point though, right? We talk about the risk side of this a lot and the fact that there is high amount of idiosyncratic risk, and to have that discussion so you don't count it as a diversified portfolio type asset with downside protection.
Yeah. But I mean, when we're doing projections, we often will include it as an asset because I think the implications of not doing that are really important. You can end up massively over saving. Now, if it truly does go to zero, then I guess maybe you're under saving. But yeah, maybe to an extent, it depends on the company too. If it's a tiny company, maybe you'd be more inclined to treat it as a riskier asset.
I had a client who we were talking to last week who exercised a bunch of options with a company in the oil industry. And he says he can't imagine, well, he can do the math, but at that point, I can't imagine had I held on to the impact of the current pricing would have had. So it just shows you, and like I've lived through like Enron and Nortel and other experiences where there's been massive downside. We've also lived through a lot of, this is someone with a tech company in Seattle, so they've lived through massive upside as well. And you don't get that kind of upside in a diversified portfolio.
Yeah. And my experience with employer stock held like that is that you can't do a whole lot from the perspective of putting in place any collars or anything like that. Like, you can't use derivatives to protect your position. In my experience, maybe that's not always true. I don't really know. That could be something that some people might say you should do. But again, from what I've seen, most companies have restrictions in place where employees are not allowed to do stuff like that. That's not to say nobody can.
But I guess the question also is, like, once it does vest, I guess it depends on the dollar amount, but we often advise people to decide on a liquidation strategy, deciding the amount of time you want to hold, and just methodically chip away at those holdings by liquidating them. We don't know the magnitude of this person's holdings or concentration.
It depends on the situation too, though, right? Like, if in some cases, if it's a big dollar amount, we might be having a conversation about what is the minimum amount that you need, assuming that there's more than you need to achieve your financial goals. What is the minimum amount that you would need to do that, to, fund future consumption, basically make yourself able to retire now, buy your house in cash if you want to buy a house, check all those boxes, sell enough to do that. And then the rest, if you want to take the idiosyncratic risk of an individual stock, then go for it. I think psychologically, doing what you said, Cameron, is it chipping away over time. Psychologically, in a lot of cases, people have had a lot of success with that. But I also think that our recent sample anyway is biased, just because we've been having these conversations with a lot of people who have been employees of companies that have had stock prices that have gone up a lot.
Exactly. We're very biased. Anyways, hopefully, Raleigh, that helped. And if you have additional questions, please follow up. Anyone else out there that has questions, please do leave us an audio recording. We'd love to hear them.
There's a ton of, just to add on to that real quick, there's a ton of crazy data on the tendency of employees of companies to hold their own stock if that stock has performed well in the past.
Definitely.
So that might be another really important piece of this conversation, is recognizing that you're probably, now maybe Riley's not because he's asking the question, but there's a good chance that you're biased toward the stock of the company that you work for. And that'll especially be true if it's a company whose stock has gone up in the past, even though that doesn't mean anything about what's going to happen to that company's stock in the future. So checking those types of biases when you're making these decisions is, I guess that's just obvious, but I think that's one of the hardest things for people to do when they're dealing with their own company stock.
So let's go ahead with our interview with Ben Rabidoux.
Ben Rabidoux, welcome to the Irrational Reminder podcast.
Thank you for having me.
Can you briefly introduce who you are and your business and the type of research that you focus on?
Sure. Ben Rabidoux. I run a boutique research firm called North Cove Advisors. My main wheelhouse is Canadian housing, macroeconomic trends, and household credit. So we work with institutions to try to keep them ahead of big trends in the economy, and then also sort of idiosyncratic credit risk with individual companies.
Interesting. So who would your clients be?
Well, they're anything from Canadian mutual fund type companies with big banks to pensions to hedge funds or big sovereign wealth funds. It's kind of a range. Anybody that may own some of the big Canadian banks or some of the smaller financial institutions, or anybody that just has a keen interest in Canadian macro trends may find the research helpful.
Interesting. So mostly like active fund managers, I guess. Would that be a fair category?
Yeah, that's fair. Yeah.
Cool. I got to ask, I wasn't going to go here, but since we're there, do you have a view on index investing versus active management?
Well, listen, man, I think the day it is what it is. It's hard to outperform consistently, but I think there's also, in a lot of cases, a lot of value to having professionals help you to not make mistakes when you get into periods of market turmoil. Bearing in mind that my clients are the active managers, I'm not going to say anything bad about it. There's a very real service that they provide, so that's as far as I'll go on that one.
Okay, cool. I just had to ask because the conversation took that direction. Okay, so back to what we actually wanted to talk to you about. Can you describe, just because you have your head deeper in the stuff than anybody else, can you describe what was the state of the Canadian economy before all of this coronavirus stuff happened?
Well, it's funny. There were some signs even ahead of this that there was some slowing in the Canadian economy, particularly coming out of the manufacturing sector. We were seeing that you're starting to see manufacturing sales come under some pressure. You were seeing there was a pile of inventory piling up at both wholesalers and manufacturers, which generally portends a slowdown in manufacturing output. You're starting to see things like employment start to soften at the margin. Some of call them like the secondary indicators within employment. So things like temporary workers were starting to decline a bit. You were starting to see hours worked come off a little bit. And that's all generally indicative of just a modest softening in the job market. We'd seen the market's been very tight for quite a few years. And if you think about what employers tend to do when you go from a very tight labor market to a little bit of a softening, they don't want to let their salaried employees go because they've come out through a period where it's very hard to find that labor. And so you don't want to let them go. And so what you start doing is you reduce overtime hours, you cut temporary workers, you do everything you can to hold on to that core group. And we were seeing that. So I actually think that heading into this, there were some signs that there was some weakness already in the economy. The other thing that's interesting is the composite leading indicators had really taken a very lengthy and protracted and steep downturn heading into this. And so there were some signs that the economy was not quite as robust as the headline numbers suggested. And what's interesting is that a lot of the strength was driven by the expansion of the population itself. So in other words, if you looked at real GDP per capita, it had already flattened out. So the gains in the economy were really coming from very robust population growth. And so that was where we were at heading into the recession. Now, the interesting thing is that driver of economic growth being population is going to be one of the things that's really going to challenge Canada going forward, I think, because there's some dynamics now that are going to really challenge whether or not we can sustain anywhere near the current level of population growth that we're seeing. There's a few layers within that, but just in a very short kind of story, it goes that we had 550,000 headline nominal population growth in Q4, which is mind-boggling in Canada. Just an enormous number to the point where you could argue that you can't actually house that many people. You can't build enough. There's physical constraints in the construction process and capacity. And so, you end up doing all these things like creating these rental crises around the country. Now, within that 550, you have 200,000 that are non-permanent residents. And primarily that cohort is made up of work permit holders and student permit holders.
What sort of work are they doing?
Well, they're everything. I mean, right across the economy, if you look at some of the research from the Canadian Federation of Independent Businesses, you had virtually every sector were reporting significant tightness in the labor market and an inability to find both skilled and unskilled labor.
Wow.
Right? So I was talking to one franchisee owner, and he owns a handful of McDonald's franchises, and he was telling me he was bringing in 12 kind of like middle management folks, foreign workers, to fill that need because he could not fill it domestically. And what's interesting is he said, people don't realize how expensive that program is for employers to bring those people here, because not only do you have to pay them a competitive wage and prove that it's a competitive wage, you also have to pay an outsourcing firm to bring those people here. So there's like a fee layered on top of it. And so when I said to him, well, what are you going to do when the economy softens? He was very clear. He said, the moment we can hire domestically, we're going to do that. And then we're going to basically send those people home. And so what it means, you take that dynamic and you multiply it thousands of times. What it means is that non-permanent resident cohort that's been a significant tailwind to population and then by extension to headline economic growth, that's most likely going to go into reverse. It generally does during recessions because those programs are designed to expand to meet the labor market needs and then to contract when the economy weakens. So, we came into the recession in a relatively solid place economically, but with some very notable imbalances or potential vulnerabilities.
And what about levels of debt, like both consumer and corporate debt?
Well, this is an area where I've spilled a lot of ink. Both are high, extremely high, record highs, both for corporate and for household debt. To me, there's two elements to it. There's the one that gets a lot of the headlines is just the debt to income ratio, which of course that misses things like the carrying cost of that debt, which in a lot of ways is more important. So in other words, in a declining interest rate environment, it's very much what you'd expect to see in a lot of ways. Now, what's more interesting than that is we came into this recession with the household debt service ratio, which is the share of income being earned by households that's being diverted to servicing their existing debt. That was at a record high. So imagine coming into a recession with debt servicing at a record high at a time when interest rates are hovering right near record lows. Now, you could talk about people like me have been looking at that dynamic and saying, look, this is a vulnerability for a long time. Right. And you don't have to have predicted coronavirus. And certainly no one did, to have been right in flagging these vulnerabilities and pointing them out and saying, you know what, we don't know when this is going to be a problem, but when it's a problem, it's going to be a real problem. And I think that's the situation we find ourselves in.
What is the source of most of that debt? Is it housing debt? Is it general consumer credit debt?
Well, it's about 2/3 mortgage debt. But what's interesting in Canada is we classify debt a little bit differently. So in Canada, home equity lines of credit are counted as consumer debt, where in the U.S. they're counted as mortgage debt. So It's about 2/3 mortgage debt, and then another third is non-mortgage consumer debt. But of that third, you've got over half that's home equity lines of credit. So you could almost make the argument that, I got to do my math there, but you're pushing 80% of it is housing-related debt.
Jeez. How does that level of HELOC balances relate to, the obvious comparative example, I guess, is the U.S. when they had their housing crash?
Well, it's shocking in a lot of ways. So the one thing you have to know about HELOC debt in Canada is it's generally interest only and it's revolving and non-amortizing, obviously. And so there's a lot of appeal there to that form of debt. And so when you normalize it for the size of the economy, the U.S. peaked around 4.5% of GDP in terms of drawn HELOC balances. And that was 2007. And today they're under 2%. They're about 1.8% is drawn here. They've significantly delevered, both as a function of paying down the debt, of defaulting on some of that, and then also just of lenders significantly tightening new credit issuance. Now in Canada, we're closer to 13%. So we're closer to 13%. So it's an astronomical number. Now again, that's interest only, very easy to carry. My contention or my concern has always been that when you think about vulnerabilities in kind of the credit ecosystem in Canada, there's always that chance that lenders can change the structure of HELOC debt. And people don't realize this. When you take out a HELOC or any line of credit, it's a callable loan, right? Now, the chance that the banks will full out call it, the chance that the bank's going to call you up and say, hey, that $200,000 HELOC, we want it back in 30 days, relatively low. But what they could do, and what I suspect we will see, is they could ask you to amortize part of it, right? They could say it's no longer interest only, but we'd like to see you start amortizing this because we're getting concerned about property valuations.
Right.
And it's an entirely plausible scenario. But I think even more likely than that is that they just flat out start canceling some of the undrawn balances. So you thought you had $200,000 in HELOC space. Maybe you have $20,000. Maybe you have none. Now, that's not going to be for everyone, right? The banks still want to make money. So if you are a doctor with a stable employment and a good balance sheet and a low LTV loan on your house, are they going to cap that? Probably not. But if you're a self-employed tradesperson, that's sitting on a $200,000 undrawn balance. Like, at what point do the risk managers start going, maybe we don't need to have that sort of potential risk sitting on our books?
Or they could raise the interest rate on that debt as well.
100% they can do that. And what I think you will see is if people don't realize it, if you miss a payment on an unrelated credit product through that same bank, the lenders have the right to increase your HELOC debt or increase the HELOC interest rate, right? Not only on the undrawn balance, but on everything you've already got outstanding. So there's a lot of ways that banks can really screw with you on that HELOC debt. Now, again, it's one of those things that never happens when the economy is doing well. But when you get into a more stressed environment like we are today, the book gets rewritten oftentimes. And what we're in right now is quite unprecedented. So it's hard to say that anything is off the table.
Is it too far of a stretch, and I hope it is, to compare our current situation to 1990 Japan?
I would say that's probably a stretch. Again, not being a Japan expert by any means, but certainly the demographics are very different. Japan just was a very closed economy in terms of not wanting to bring in immigration to kind of keep their labor market productive and young. That's not really our problem right now in Canada. Now, my fear, though, so I would argue that Japan, in addition to just being an incredibly egregious bubble at peak, both in terms of the property market and their stock market, which really is hard to make that same argument for Canada right now. But the risk is that, like Japan, when the economy sours, the sentiment and the politics change such that immigration becomes much less palpable. And you do end up with a situation where demography just weighs on growth for a long time. And to me, that is very likely because as we talked about, I think the non-permanent resident cohort is going to be a huge drag for the next little while, probably 4 to 8 quarters. But beyond that, when we tend to see in previous recessions, like immigration tends to plunge. Right, for a few reasons. One is just that the job opportunities aren't there. It's hard to move to a country where the unemployment rate's 15%, which is very likely where we're going. But not only that, the politics is just completely different. Like, you start hearing these arguments, and they're already out there. You can see them on Twitter from the fringes, but they're going to become much more mainstream. As you're going to start seeing people going, are we willing to bring hundreds of thousands of new people to Canada when I don't have a job and one of my neighbors out of work? Right? It's just a very different dynamic. And that was the road that Japan went down. I fear that to some extent we could end up there too.
Interesting. You're so right about the bubble aspect though. Like Japan, price earnings was 75 times Shiller Cape or something like that, or 75 Shiller Cape, which is almost twice what US was in the tech bubble. Anyway. I'm
curious on the employment side. You talked about the number of non-permanent workers. So what's the impact by region? And I'm thinking mainly about like this implosion of the price of oil. There must be huge regional differences, I'm guessing.
Well, there is in terms of the fallout. I would say that, look, I think there are enormous structural issues in Alberta right now and any of the energy provinces. And it would not surprise me if things don't turn around quickly that we aren't talking about sort of a federal bailout for both the provinces and the municipalities within those provinces, because it's an unmitigated disaster what's happening out there. Now, the one thing, if they had anything going for them coming into this recession is that they already kind of knew what pain was, right? They were, it's one thing to use the car analogy. If you hit a brick wall going at 20 kilometers an hour, it's a very different sensation than hitting it at 100, right? And in one sense, Alberta's hit a brick wall going at 20, but Ontario is hitting it going at 100. Right. So it's going to feel very different. The shock is going to be very different. So from an absolute basis, it's going to be a very different experience in terms of the hit to population growth. Toronto really was the main recipient of a lot of the immigration coming into Canada. It's unlikely that's going to be the case going forward. Alberta really was not. You could see there was, you could see in the data there certainly was some inflows, but nothing like what we're seeing in the big cities in Ontario and BC.
Interesting.
Can you talk a little bit about so we talked about the economy in general. Can you talk about the state of housing in Canada before the whole coronavirus situation?
Sure. It looked awesome, right? It was crazy. We came out of a period in 2017 and into 2018 where you had the combined effects of policy measures aimed at kind of curbing speculative demand, to call that foreign buyer taxes and Airbnb measures. And then you compounded that with these very significant credit measures, macroprudential measures from OSFI. And so 2018 and into early 2019, you saw pretty significant weakness in places like Toronto, parts of Vancouver. You saw in some regional pockets, you saw house prices come under substantial pressure. So high-end single family homes in York region in Toronto. A lot of places there saw 20 to 30% off peak to trough. So very significant declines, but that was by no means a metro level decline. If you were looking at entry level, still stayed firm. So you kind of skated that. And then by mid 2019, it got to the point where one of the strange dynamics we saw was that new listings started to really fall. So new supply coming into the market was down dramatically. And so that was occurring at a time when sales started to pick back up. And so by the time that we ended 2019, we actually had over a 10-year low in active listings across the country. So the inventory was very low. Sales were not robust, but they had picked up enough that you were kind of back to reasonable level of demand. But because inventory was so low, I was making the argument with my clients that this market was so tight coming into 2020 that we would see 15 to 20% price appreciation nationally by the summer if something didn't change.
Wow.
Now, the reason I mentioned that, and the reason I think it's important, is it's very different coming into an economic slowdown and a housing slowdown if you're starting at a position of 2 months of inventory, right, which is a very tight market, versus coming in with 8 months of inventory, because it does buy you time. And the one thing we know about recessions in Canada and housing downturns is that the magnitude of the downturn is actually less important than the duration. Right. So to use 0809 as an example, it was a very steep, very quick recession here in Canada. And that matters a lot for housing because people have this incredible ability in Canada to kind of keep their fingers in the dam and muddle through and find a way to not default and find a way to not sell into weakness. But that only lasts for so long. And so if the economy drags on and the recession persists beyond a year or even a couple quarters, let's say, that changes. And so then you start seeing distressed selling. And if that distressed selling is coming into a market that's already well supplied, that's a recipe for a very weak housing market. And so I would say that the important point there is that we've come into this recession with a bit of time in the major markets. It's going to take a while before the markets sort of shift back towards a seller market.
It's really interesting because I noticed in our neighborhood there is definitely a lack of supply. New construction is going on, but it's slowing. So I'm curious, how important is real estate to the overall economy? And what's the dynamics there about supply coming online? And there's this dislocation that I'm witnessing as we walk around our neighborhood of new housing, old housing, nothing listed. Like, how does this all sort itself out?
Well, it's a great question. I would say that there's sort of two main ways that housing boosts economic growth. And there's sort of the direct channel and then the indirect channel. And so the direct channel would be directly through what we call residential investment. So that's construction of new dwellings, that's renovations, transaction costs, and all of those are at or close to record highs in terms of their share of GDP. So we have never been more reliant on the direct channel of housing to the economy. One sort of microcosm of that is if we look at what's called real estate transfer costs, which is primarily realtor commissions, but also legals and transfer taxes, et cetera, but primarily realtor commissions. It's almost 2% of GDP in Canada. It's like 1.8. Wow. Now you look at that and you go, well, what does that mean? In context, historically, what does that mean? Well, it's way above where it's ever peaked. Long term, it's normally around 0.8 to 0.9. And in the US, it peaked around 1.5. So just that one sliver just gives you an indication of how reliant we are on housing to drive economic growth. Now, that's the direct channel. It's amazing, right? It's amazing. Like, it's stunning to think of that. There's been some quarters in Canada where you look at the headline GDP growth and it's been like 30% of the gains have been just from the increase in real estate transaction costs, right? So in other words, like 30% of the headline gains is like, we're paying our realtors more.
How does that compare, like other markets globally, like Australia and New Zealand that have had crazy high prices like Canada? How do we compare on those stats to them?
That's a great question. I don't have the data for those countries. I would assume they would also be similarly at record highs. I mean, they have a lot of the same dynamics that we're having here. I'd even argue that Australia is much frothier and much more fraught with risk than Canada is, but it's the same story. You know, they've seen huge inflows of foreign capital, lots of domestic speculation. Their building boom is significantly more pronounced than ours there. So it's got to be, I have to think it's the same dynamic. But the U.S. is kind of the easiest comparison because they're our neighbors. Generally, the economies tend to sort of mirror each other over time. And it's just such an interesting thing to see that we are so far above where they were by this metric, and especially where they are currently. I mean, residential investment in the U.S. is back down to 3.5%, 4% of GDP, which is just bouncing along record lows, right? So that's the indirect channel. And then just as importantly, I would argue is consumption. And consumption is to some extent a function of things like the wealth effect. So how wealthy you feel is often indicative of how much you're willing to spend, particularly as it relates to large discretionary purchases, vacations and purchasing toys like boats and ATVs or whatever it might be. That really is largely a confidence game, but also an access to capital game. And so as your house rises in value and you can access this incredibly cheap debt via a HELOC, your propensity to consume goes up. And so if you put consumption and residential investment together, it's been about 85% of real GDP growth over the last 5 years. So it is the economy, is the bottom line.
Wow.
So what would you tell someone considering buying a new home right now?
Well, I would say it wouldn't hurt to wait and see how it plays out. Actually, I realize I missed part of your question. Let me bounce back, because you also asked about the supply picture in Canada and construction activity. It's interesting. So we are at a record high for what's under construction across the country. It's about a little over 250,000 dwellings are currently under construction. That is a record high. Now, we're also seeing a record high in purpose-built rentals. Sorry, I shouldn't say a record high. We're at a 50-year high in purpose-built rental activity. There's been a lot of talk for years about we're not building enough rentals. That's changing. About 70,000 rental units under construction right now. And what's interesting is 6 months ago, you could look at that and say, even at this record high, I don't know that it's going to be enough, just given how strong population growth is. Today, that's very different, right? Because those units are probably going to be completing into a very different demand picture. And again, there's so much about this whole crisis that is unprecedented and unknowable, right? Both in terms of the magnitude of the hit to the economy, but also the size of the fiscal response. So the Feds have already said nothing's off the table, and I believe them. Nothing's off the table. Could they double or triple the Canada Emergency Response benefit next month? Yeah, of course they could, right? And so to what extent are they willing to underpin and support incomes? That's going to really matter in terms of how this all plays out. So I speak as if I've got some level of confidence in this when I say this is probably going to be delivered into a very different demand environment, but I have no idea. But I think a reasonable base case is that there will be substantially more supply relative to demand over the next 6 months or a year.
What are the data showing right now about, you mentioned the rental supply. What are the data showing now about rental supply coming online? I keep hearing about things like Airbnbs being put in the long-term rental market. Yeah,
it's a thing. That's absolutely happening. So there's a few dynamics there. One of the most interesting things that we noticed in the back half of 2019 is we started seeing just this huge spike in rental condos being listed on the MLS. And I'm talking specifically in Toronto. And Toronto is where we get the best data for this. I don't know if it's a thing in places like Ottawa. I would imagine it probably is. And I know it's a thing in Vancouver. But just using the Toronto Real Estate Board data, we started to see this big spike in condos that were listed for rent. And we're talking like 30 or 40% year over year, these big gains month after month after month. And to the point where I tracked the condo rental market pretty closely in Toronto, and we started to see that rental rates started to flatten out. You saw rental demand was up substantially, 10, 15% year over year, but you were seeing like persistently 30 to 40% increases in supply. And so what it was, it's very interesting, is it was people who owned condos and then wanted to trade up to, let's say, semis or detached, whatever it might be. But rather than list their condos for sale, they would keep them as rentals. And so, we're hearing this anecdote from everyone in the real estate industry, and you could corroborate it with the data. So the reason I mention that is because, like I said, that had the effect of taking a lot of the froth out of the rental market coming into this. Rents were already flattening out coming into this. Now you layer on top of that a very different demand picture via lower population growth and a pile of new supply coming online in the next year or two, right? We're projected to have record completions in Toronto for condos in 2020 and 2021, and a 50-year high in completions in rental units, purpose-built rental units. All of that's coming online in a very different demand environment. Not only is it going to be that population growth is lower, but I suspect we're going to find that household formations, sort of organic household formations, are going to be very slow. And what I mean by that is in a normal functioning environment, or economy, I should say, you'll see young people who are living with their parents. They might move out and they'll get a couple of roommates or whatever, and then they'll live there together for a while, and then they sort of all go out and they form their own households. And so those people, household formation is sort of relatively predictable when you look from that perspective. But when you get into these economic shocks, all you have to do is ask yourself, how many kids who are living in their parents' basement right now that in a normal economy would be going out, starting careers, getting their own place, either renting it or buying, and just starting their life that way. How many of those people are going to look at this economic environment and go like, you know what, maybe I'll wait a year and just see how this pans out. Being in mom and dad's basement is pretty safe right now.
I've got two of them.
That's a very significant dynamic as it relates to rental demand and housing demand at the lower end. And so, I think demand for rentals is getting hit from multiple fronts. Right? And then again, to your point, all of this is happening at a time when you've got 15,000 Airbnb units in Toronto that some large portion of that is going to enter the long-term rental pool or will be sold off, right? Because you've got regulatory changes from the city, plus the fact that you've got a 95% reduction in revenues. Right, which is going to force their hand for a lot of these people.
Jeez.
15,000. That's incredible.
It's a lot. It's been kind of a blight on some of the urban areas that you've just siphoned up so much housing stock in these sort of ghost hotels.
Now, are rents falling, or we're talking about the data suggesting that they probably will fall?
Oh, they are falling. Yeah, no, I know at least in Toronto and Vancouver, you're starting to see them soften. Now, Again, you're looking at anecdotes. You're seeing very specific buildings where this exact type of unit, 2-bed, 2-bath, was trading consistently at, pick your price level, $3,000 for the last year. And then all of a sudden you get one listed at $2,900 and then at $2,700, and just in the last 6 weeks. So You do see it. I mean, it is happening. And I wouldn't be surprised if in places like Toronto, you see the headline rent drop 10%, peak trough. I mean, easily peak trough. Now, that's not to say it's tricky because the overall data may not show that because we report average rents across the entire rental universe. And that changes very slowly. But the people who are transacting, the people who are actually moving, those rents, the spot rents are going to fall, I suspect, at least 10%, maybe 20%. I mean, Alberta, the spot rents fell 30% in Alberta.
So that's rent. What about real estate prices? What are the data saying about that?
Well, you have to think that the bias is going to be downwards. Yeah. Trying to find or estimate the magnitude of any potential drop is very difficult because you're into then estimates around various property types and you're trying to get the temperature across the entire country. But I'll say this, I would say the high end of the market, the less liquid components, the luxury markets tend to perform the worst. They go very illiquid. The financing tends to tighten there first. And we're already seeing that. It would not surprise me to see luxury market get hit 20, 30% in some areas. The entry level gets a little trickier. They tend to be a lot more liquid. I mean, we could use the 2017, 2018 downturn in Toronto is a great example. Core Toronto, single family and condo in the core, prime areas fell maybe 5-10% peak trough and then recovered quickest. The further you got away from the core and the more expensive you got, the worse the hit was. So that by the time you were out in York region for $3 million homes, they were literally trading down to $2 million, right? Wow. And that's a very plausible scenario in a lot of the big metros. But again, it gets back to me, the bigger question is the length of this downturn. That's really going to be the question here. We know it's an incredibly steep downturn, but if it's a 2-quarter recession, that's a very different picture for housing than if it's 6 quarters, right? 8 quarters. And that's the difference in a lot of ways between 08, 09 and say 89 to 93. And I know huge difference in interest rate environment between those two. But the point being, when you get into this protracted downturn like you had in the early 90s, it's just devastating for housing.
Is the duration your biggest concern? I mean, you're working from home. You're looking at all these different numbers. Is that what is your biggest worry?
Well, I don't know if it's my biggest worry. The magnitude is stunning, right? I mean, this really is unprecedented, but I think like you're almost used to these incredible charts. Like every single macro chart is broken now, right? Like it's going to be broken forever. I mean, the magnitude of the job losses, you're going to have to literally snip out the next 6 months because you won't even be able to see the trend change on the chart going forward because the magnitude is so enormous right now. It's almost like you almost get used to the shock value, right? Yeah. So we know it's a tremendously deep recession. We're probably looking at 30% Q2 GDP decline on an annualized basis, right? Which I don't even know that we don't have great data going back this far, but I don't even know during the Great Depression we saw it fall that much. So it's going to be stunning. But the big question is how much that's going to prove to be temporary, because there will be a big portion of that that's going to snap back once you start lifting some of these restrictions. So in some ways, it's a very unique shock to the economy. But yeah, I would say my concern right now is what the macroeconomic environment looks like a year from now, right? That to me is going to be the big determinant of how house prices perform.
Interesting. And I guess another big difference between this and the Great Depression, probably, I haven't studied it in any detail, but the fiscal policy response, what we're seeing now is unprecedented. I don't imagine they had anything similar during the Great Depression time.
Yeah, I'm not an expert either, but certainly the fiscal policy, I would have to think, is much more aggressive, or however you want to frame it right now, but also the monetary policy.
Yeah.
Right? I mean, going to zero rates and some of the measures that they've taken to keep liquidity flowing is stunning, right? I mean, the Bank of Canada's balance sheet's just unbelievable. So there's a lot of things that are unprecedented about this whole thing, and that's why it's so hard to have any concrete view on things. You sort of have to think about a base case and then think about the distribution of outcomes on either side of that.
Right. And
I think a reasonable base case is that the pressure from here is downwards on housing, right? Now pick your number. I mean, it's not hard to get to 10, 15, 20% as a base case from here, with significant, very large tails on either side of that, because we just don't know. We get to a 30% national house price decline? Absolutely. Right? Could it be 10% in a very quick snapback such that we're back to zero or back to where we were within 18 months? Like, yeah, that's totally plausible too, right? And nothing's off the table right now, but my bias is that this is probably going to be pretty bad for housing.
Can you speak to, and a lot of people don't even realize that we've ever had these in Canada, but we have had housing downturns in major markets in Canada in the, I think, late 80s and 90s. What were the economic conditions like then? And how do you think that compares to what we're seeing now?
Well, it's funny. So you're right. The big one was kind of 89 to 93, but we also had a housing cycle in the late 70s as well. It seemed like there was one almost every 10 years for a while. Though. You had like one late 60s, late 70s, late 80s, nothing so much in the 90s, and then it blew up again in 2008, 2009, very quick blip. What's interesting to me, and this gets back to your question earlier about how levered we've gotten the economy on housing, both directly and indirectly. If you look back at the late 80s and early 90s, one of the defining characteristics of the Canadian labor force is that we were a manufacturing powerhouse. And so when the central bank slashed rates and decimated the currency, it was a boon for all of these manufacturers, and it just roared back. And it ended up soaking up a lot of the relatively low-skilled labor that was shed out of the construction sector. Now, it's not clear to me how you easily stimulate the economy at this point when you are starting at a position where rates are so low, right? And you don't have the same sort of leverage to declining currency that we had back then. It's going to be very difficult. I mean, the easiest way to think about it is if you look at the household effective interest rate, which is kind of the blended interest rate that households are paying across all of the outstanding debt. Heading into 2008, that effective interest rate was about 6.5%. So I mean, just imagine telling people today that just, 13 years ago, the average rate across all the mortgage debt outstanding, credit cards, everything, 6.5%. We'll look at you like you're crazy. A year and a half later, it was 3%. So An enormous decline. There was shock and awe value from the Bank of Canada cutting to zero. Now you fast forward to today, we're coming into this recession with that effective interest rate at about 3.3%, right? And they've cut to the lower bound. They've already cut to 0.25% at the Bank of Canada. We're down to 3.1. Where's the shock and awe, right? So if you don't have 300 basis points of rate cuts to stimulate demand, like what are you going to do? That's been my concern here is how do you leverage the consumer to pull the economy out of a recession, which has been the playbook for decades now. It's very different. It's a very different environment. And that's why, I've said to my clients, I think what we're going to see this cycle is very dramatic and unconventional monetary policy. Negative interest rates wouldn't surprise me. I mean, extremely aggressive QE. Well, the Fed in the U.S. is already buying high-yield debt ETFs. I mean, who in the world thought even legally that they could do that, right? So we just don't. Again, get back to the big question. We have no idea what policymakers are going to do here, but it's probably going to be pretty crazy, right? And it's going to be something that's going to rewrite the textbooks.
Yeah, QE is a fascinating experiment too.
It is.
Do you have thoughts on the Bank of Canada? I think just started doing the QE program. Do you have thoughts on whether that's going to have any effect or not?
Well, it's going to have an effect in that I think there's a lot of concern that's going to be inflationary. For quite a while, it's going to be hard to see that. I mean, I'm conflicted on that. So on one sense, if you think about the economy as like a boat, let's say, I don't know, this may be a bad analogy, but if we're a $2.3 trillion economy and real GDP is probably going to be off somewhere on the order of 5% this year for the full year. Well, that means you're going to need somewhere on the order of $100, $120 billion in direct stimulus just to plug the hole so that the boat doesn't sink, just to keep you at stable level, right? So not getting into any sort of excess inflationary type money printing. That's just what's going to be needed to fill the hole. So it's necessary, right? And the problem is that the feds and the provinces now are going to be issuing so much debt in the markets to try to stimulate their own economies that there has to be some question around whether the appetite's going to be there to take all that on, right? So I don't know. It's certainly something that rightfully should give us some level of concern. But at the other end, like, what are you going to do? It's like when the crap's about to hit the fan, you got to do something, even if it's going to be wrong, right? Like, you got to do something. So that's kind of where they're at, right?
Yeah. And I guess empirically, we've seen in the US and Japan, well, the Eurozone too, they've had these huge QE programs and it has not been inflationary at all.
Right. Completely broke all the models on that. You're totally right. The one thing that worries me right now, and again, not being an expert on this, but I would say there's a couple things. One is I do think that there will be some inflationary pressure just based on what's happening with supply chains.
Right.
Supply chains being broken. I think you're going to see supply chains start to be repatriated, for lack of a better word, but people start to question the stability of their sourcing materials and parts overseas. And that's going to be inflationary because it's going to be harder to source that at such cheap levels. So that's one thing. I also think there's a very good chance that we see the Canadian dollar get hammered here. Right. I do think that we're going to challenge the current AAA rating in terms of sovereign credit ratings. And if you look at the leverage in Canada across all sectors, so you look, like, people often have this assumption that because the federal balance sheet is relatively pristine, that we sort of stand out internationally. But what people miss is that Canada is unique in that the sub-sovereigns, which is to say the provinces primarily, bear most of the burden for healthcare and education, which in most countries is the biggest expenditure and the biggest drain on the fiscal balance sheet. And so when you layer on top of the feds the provincial debt, municipal debt, households and corporates, all of a sudden we're among the most levered. And then when you look at us relative to, let's say, the G20 aggregate, we're about 60 points above. We're about 300, by my math, we're close to 330% debt to GDP, which is way above the G20 aggregate. Right, way above a lot of comparable countries like the US, Australia, the UK even. And so this downturn, there's going to be a lot of entities and parts of the economy that are going to need to be bailed out. And it's not clear to me that you can keep that AAA rating. And so if that starts to happen, and if the currency starts to get hit, which I think it probably will, then you also have the issue of importing inflation via imports, right? That everything starts to become more expensive. So to me, that's the other risk in this.
I think I just have one more question. On housing, can you just talk about your thoughts, separate from the current situation, on renting versus buying a home? This is something that I've talked a lot about. I think renting's as good of a housing choice as owning. I guess I'll say it that way. Okay,
so first off, big caveat being that any personal finance question, questions like that, I always say it's like asking how long is a piece of string. It's like, well, it depends. So is it the right time to buy? Is it the right time to own? Well, I don't know. How stable is your job? How big is your down payment? How stretched do you have to be to afford that home? How long are you going to stay in that area? And these are all the sort of personal finance elements that make a question like that impossible to give a generic answer. But I'm sympathetic to your view that there's this tremendous bias against renting in Canada, and I think it's unwarranted. The one pushback to that would be that it's unfortunate in Canada that we don't have great, long-tenured, single-family type rentals. And so the issue that we've had in Canada is a lot of the rentals, especially a lot of the nicer or higher end ones, end up in the hands of sort of retail landlords. And they're just prone to do all sorts of stupid things and try to rent evict you, and they'll sell at the most inopportune time, the short holding times, all this stuff that inconveniences you. And so at some point, if I was a single person, renting all day, it makes a ton of sense. When you start throwing kids into the mix and the risk of having to deal with retail landlords that are going to rent evict you and do all sorts of other stupid things, comes a point where the cost of convenience is worth a lot too, right? And the cost of not having to move in the middle of the school year, all those intangibles come into play as well. So I agree with you. I think this is a great time to just wait and see how things play out, because again, my bias is that this is more likely to exert downward pressure on housing. And I think it's more likely that you're going to end up with very good deals in the rental market and later down the road in the resale market. But even outside of that, I think the economics make a lot of sense around renting right now.
Right. Yeah, I agree. Renting's pretty good.
We know Ben agrees with you.
I rent. I have 4 kids. Geez, I just had another one.
But you know what I mean? Like, if you can get a place where it makes sense and you're comfortable that the landlord's not going to do something stupid, like absolutely. I mean, it's crazy. So we rented, I mean, it was a beautiful place. It was, we had our 2 kids when we were there, and like our rent payments, I think were, gotta think back, like their property taxes were about 5 months of rent payments just to cover the property tax. I mean, we were looking at this going like, these people are giving this away. I mean, this is an unbelievable subsidy on our living. We would have stayed there for a long time, but it was the same thing. They eventually wanted to think about selling it. And we're like, you know what, kids are getting to be school aged. We're in a fairly low cost housing environment where we are. And it's like, well, we found a great spot that we loved and we ended up buying it. But had it not been for that, if we could have stayed at the other place, we probably would have for quite a few more years. Right. So a lot of it to me comes down to stability of tenure too.
I've often thought that in Canada, and you may have the data to back this up, which is why I'm bringing it up. In Canada, in many cases, landlords will do that. They'll accept losses on renting a place out because they have such high expectations for the capital appreciation. Is that something?
Yeah, absolutely. Oh, well, the data is clear on that. I mean, we know about half landlords are cash flow negative when they take possession of new condos. Right?
Wow.
That's even with their down payments. So you're right. It ends up being a subsidy. Now, the counterpoint to that, and one that, again, I'm not a fan of this math, but the math isn't necessarily wrong. So one of the things that gets lost in that is that with interest rates as low as they are, about 50%, once you're below 3% mortgage rate on a 25 or 30-year AM, about half of the payment from day one is principal repayment.
Right.
So the argument that they would make would be, okay, I'm out of pocket $200 a month, but I'm getting $600 or $700 of principal repayment. So net, I'm up $500-$600 a month. If you actually then look at that in terms of my down payment on a levered basis, the math is actually really interesting. It's a very good investment. Now, I don't like that math. I think that math is, if it's one person doing it, you go, okay, well, that's kind of interesting. But if it's like half of all condos are coming into the rental market with that math behind them, well, it creates potentially a systemic vulnerability when you hit a shock like we're having right now, where all of a sudden I may not have that money to pay that out of pocket because I'm unemployed and my tenant might be unemployed, so I'm not getting that rent. And so then it becomes very serious. Then all of a sudden everyone goes, okay, now I understand why people want cash flow, right? And positive cash flow. So I'm with you. I think that both the low rates, the reach for yield, and the capital appreciation that we've seen in recent years has brought a lot of people into the long-term rental market, into the investment market that maybe shouldn't have been.
Fascinating. All right, last question. And I know personal finance is not you. I'm not saying you're an expert in it, although you may be. But that's not why you came in the podcast. But I'm going to ask this question anyway. Knowing what you know and just spending so much time with the data and seeing what's going on from an economic perspective, is there anything special that you're doing right now to prepare yourself and your family's personal finances? Oh,
that's a good question. Again, we're pretty fortunate in that we've had a fair bit of liquidity coming into this and really positioned, not as well as I would have liked to have been in terms of everyone, when something like this hits, you always wish you had a little more cash on the sidelines. But for us personally, it was just maybe you build up a bit more of a reserve because you don't have any idea how long it's going to last for. I'm fortunate that my household really hasn't seen any sort of income interruption from all of this. So it's maybe a little different if I sort of rephrased it to what the average person might want to think of doing. It makes a ton of sense to start building more of a safety net or a cash balance or an emergency fund, and just think about de-risking things right now. Because not de-risking in the sense of like selling equities right now or whatever it might be, but just make yourself a little more resilient to these sorts of economic shocks, especially something like this that we don't know how long this could drag on for. Right? It certainly highlights the importance of having a liquid emergency fund that, by the way, is not in the form of a line of credit that can be called in when things get distressed, right? That to me has been one of the weird sort of personal finance things that we've seen lately. It's like, well, you don't need you don't need an emergency fund if you have a home equity line of credit there. Well, what if the banks cut it, right? What if all of a sudden they take your limit down to nothing, right? That's the sort of thing where, it's completely reflexive in that the banks do things like that exactly the time when you would want it, right? It's like the old saying that bankers are someone who gives you an umbrella on a sunny day and then wants it back when it's raining. That's all you have to remember about bankers. You can't count on them to have that credit line still there when you really need it. So, to me, that's maybe one of the big personal finance takeaways in all this.
I totally agree with you. The scary thing is if everybody does that, we end up in a situation where there's no recovery.
Well, you're right. Isn't that interesting? So that's that whole paradox of thrift. And something that I've actually thought about a lot is that I do think coming out of this recession, you're going to see savings rates rise a lot. We've seen savings rates in Canada over the last 3 years have averaged a little less than 3%. In the US, they've been 8 or 9%.
Wow.
So we like to sort of laugh at these crazy Americans that blew themselves up. The reality is they've repaired their balance sheets dramatically, and they've been saving at a rate that's 3 times what we've been saving. So you're going to see savings rates most likely rise significantly on the other side of this. And you're absolutely right. It's a major headwind to consumption.
Jeez. All right. Well, I think we'll leave it at that. This has been awesome, Ben.
My pleasure, guys.
Yeah, it's been a lot of fun. And man, I'd like to have you back on a regular basis to get these kinds of updates. It's been great.
Happy to chat. Always happy to chat, guys.